So today's topic is inventory. Chapter number 7. See, what is inventory? Inventory can also be said as stock. Am I right? Stock or inventory mean one and the same. Why? What is the use of stock in the business or inventory in the business? Definitely the stock or inventory is purchased by the business or the proprietor of a business to resell. Okay. So suppose this is a wholesaler and this is a retailer. This is a customer. So, retailer purchases goods from wholesaler and retailer sells the goods to customer. So, retailer has purchased the goods from wholesaler to resell. Okay. So, what has retailer purchased from wholesaler? What has retailer sold to the customer? Suppose retailer bought a box from wholesaler for 100 rupees and sold this box to customer for 120 rupees. How much profit retailer made? Am I right? Hello? Hello? Can you hear my voice, everyone? Hello?
Yes, sir.
Yeah, my voice is clear now. Okay, okay.
Yes,
So
sir.
retailer bought the good, the box, which is an inventory. Okay, let's say the retailer is a dealer of watches. Retailer bought a watch box from the wholesaler for $100 or rupees, whatever you want, you can say, and sold it to customer for $120 and made a profit of $20. Okay, so this is the way the business runs. And the important thing here is inventory. The inventory is that element which is creating profit for the business. Okay, now let's go ahead into the chapter. COGS, cost of goods sold. Very simply, the formula for cost of goods sold is opening inventory plus purchases minus closing inventory. So what are we doing here? Suppose let's say on Jan 1st, we started our business with like one watch box. Okay. And on Jan 5th, we purchased 5 boxes. Okay. So this is opening inventory. This is purchases minus closing in. So again, like what is happening here is we have how many boxes right now? 6 boxes. So out of these 6 boxes, 3 boxes are sold. So how many boxes are left over? 3 boxes unsold. This 3 boxes unsold, can I say this is the closing inventory? That means when I closed the books at the end of the month, what I found is I am left over with 3 boxes. And these 3 boxes is my unsold inventory or closing inventory. Can you say yes for this? Please tell me. Hello. Can you say yes
Yes.
for this? Yes. So now what will I do is I started the business with 1 box. I purchased 5 boxes. I have 6 boxes. I sold. So I'll just I sold 3 boxes. Okay. Okay. That means I'm left over with how many boxes? 3 boxes. Correct. That is my closing inventory. Fine. So till here everything is all right. Am I right? Then why I'm asking a question, why we subtract closing inventory here? Why we subtract closing inventory here? Why? So let's say we started with we bought 100 boxes. We bought 100 boxes at the rate of $10. So we sold all the 100 boxes for $12. So revenue for 100 boxes at the rate of $12 $1,200. Okay. And like, see, I have no opening inventory. There is no opening inventory. There is no closing inventory. When these two are not present or there, then definitely this is my purchases. So my COGS would be what? Opening inventory, which is 0, plus purchases, which is like how many boxes I purchased? 100 boxes, minus closing inventory, which is 0. Correct? That is the formula for COGS. Now, so I will prove you this formula. Don't worry. So now my COGS is what actually here per like 100 boxes, correct? So COGS for 100 boxes at the rate of $10 will give me $1,000. So what is my profit in this case? $200. Okay, gross profit I would say. Okay, now we will change the example and we will do the actual COGS calculation. Okay, with by considering everything. Fine. Now, let's say I bought 100 boxes and I bought at the rate of $10. I sold 80 boxes at the rate of $12. So if I bought 100 boxes, that is purchased. Let's say there is no opening inventory, purchases 100 boxes, opening inventory is nil, 0. Okay, let's say, and sold 80 boxes. So my closing inventory is how much? How much is left over with me? Please tell me if I sell 80 out of 100. Involve yourself.
20, sir.
20 boxes. That is my closing inventory. And I show my closing inventory at my cost. Because that is I did not sell till now. So I cannot show that at selling price. I will explain you that rule also in the coming pages. Okay. Now, if I want to calculate my profit, what will be my COGS? You understand here. So I will take revenue. So I should take revenue for 100 boxes or 80 boxes. I sold 80 boxes. So I'll take for 80. Revenue 80 boxes at the rate of $12. So $960, correct? Then I'll take COGS. So COGS, I have to take for how many boxes? Please tell me, 80 or 100? COGS, I have to calculate for 80 boxes or 100 boxes. Please tell me. I'm asking a question.
80.
80 boxes. Why 80 boxes? But I bought 100, na? It is because of the matching principle or matching concept. Revenue should be matched with cost. Okay. So if I take 80, if I'm selling 80 boxes, I should match the revenue of 80 boxes, which is $960 with the cost of 80 boxes to get the profit for 80 boxes. Understood? 20 boxes I haven't sold. There is no revenue. Definitely I will not match anything with the revenue. So there is no profit for those 20 boxes yet. In the future, when I sell it, I will generate, I will definitely recognize the cost of those 20 boxes and I will find out the profit for those leftover 20 boxes. Right now, I'm selling 80 boxes. So I will compare the revenue of 80 boxes with the cost of those many boxes as those many boxes only, correct? So COGS of 80 boxes. But I will do this in the form of a formula. Okay, how? See, I'm proving the COGS formula. Opening inventory nil. Purchases. How many boxes did I purchase? How many boxes did I purchase? 100 boxes. So 100 boxes at the rate of $10. So my purchase is how much? $1,000. How many boxes? I haven't sold 20 boxes. Am I right? and I should not recognize the revenue for 20 boxes, correct? Because I did not sell them. So what I shall do, I shall add or subtract? Subtract. Subtract closing inventory 20 boxes. Why am I subtracting this 20 boxes out of 100 boxes? Because I want to match the revenue of 80 boxes with the cost of 80 boxes, not with 100 boxes. So to get those 80 boxes, whatever the boxes I have purchased from that, I am removing the boxes which I did not sell or unsold inventory, or I would say that as closing inventory. If I remove that, I will exactly get the inventory what I sold. Okay, so I sold 80. So definitely the cost, the revenue of 80 what I'm generating, which is $960, I'll compare with the cost of 80 boxes. Okay, and then I'll see the profits for those 80 boxes. So to get those 80 boxes, I have to remove the 20 boxes which I haven't sold now at the rate of $10. So $200. So now that gives me the cost for 80 boxes. So that is $800. So I'll put it here. And what is my gross profit? My gross profit for 80 boxes is 960 minus 800. It is $160. Okay, please make a note of this. So in that way we can prove the COGS formula. Come on, write down. We'll move forward fast. Once done, please tell me, I'll move forward.
Answer.
Okay. So unsold goods in inventory at the end of accounting period is nothing but goods might be unsold at the end of accounting period and so still be held in inventory. So the purchase cost of these goods should therefore not be included in the cost of sales of the period. That's the reason we are subtracting this from the cost of sales. The reason to subtract closing inventory or unsold inventory from cost of sales is we are not selling that. So hence purchase cost of those goods which we are not selling should be excluded from the total goods what we already purchased. So we purchased 100 boxes. We are selling 80 boxes. So we have to consider cost of 80 boxes. So 20 boxes we are not selling. We'll remove that. So we are left with 80 boxes and we will then see what's the cost of these boxes and we'll compare with the revenue of 80 boxes and match these two and get our profits. Fine, we'll move forward. So this is the formula what they have given here and we already have discussed this. Opening inventory, purchases, like see cost of purchases. If I am speaking about a trading concern is nothing but a business which buys inventory for the purpose of selling. But there are some companies which are manufacturing companies. Okay, for them as well, there is cost of purchase, but we will not write cost of purchase for them. We will write either use the term cost of production. Understood? Yes or no?
Yes, sir.
Yes, but in your context, you need not study all this. Generally, in the management accounting, the paper F2, we will come across all this. Okay, then I'll explain you how it goes. So opening inventory plus purchases minus closing inventory. I have given the reason why we are doing it. We got the COGS. Now let's move forward. There is a question here. I would like you to find out the COGS for this question fast. No, they're asking gross profit. So I want you to find out the gross profit for this question. Do this. I'm waiting fast. Okay, I'm expecting the answer fast. So let us see how to do this question. So Perry P. Louis, trading as the umbrella shop, ends his financial year on 30th September each year. On October 1st, he had no goods in inventory. So that means the year ends at 30th September and the year starts at 1st October and they don't have any opening inventory. So opening inventory is nil here. Okay. We can say zero to for that reason. Okay. During the year to September 30, 2005, he purchased 30 umbrellas costing $60,000. So purchase is given. So 30,000 umbrellas were bought for $60,000. This is the purchase. Okay. And the umbrellas were bought from umbrella wholesalers and suppliers. He resold the umbrellas for $5 each. That means here $2 is each umbrella costing him 60,000 by 30,000. So 60,000 is the amount, 30,000 is the quantity or units. So $2 it's costing him for each umbrella. He's selling it for $5. So $3 profit he's making. He's making $3 profit. Correct? Now, but like we will see, like he's earning profit by selling how many umbrellas, or is there any closing inventory in this question or not? So very simple question. Like there is no opening inventory. Purchase is 30,000 units and he sold umbrellas for $5 each. The selling price is $5 and the sales for the year amounted to $100,000. I shall find out the revenue for 20,000 umbrellas. Am I right? Because that much has been sold. So I shall take cost for 20,000 umbrellas or 30,000 umbrellas. Definitely 20,000 umbrellas. So we will first find out the revenue. So revenue 20,000 umbrellas at the rate of $5. It is $100,000. Okay, less COGS. So COGS would be opening inventory nil. Purchases how many umbrellas they purchased? They purchased 30,000 umbrellas. Okay, and how many umbrellas they sold? How many umbrellas they
20,000.
sold? So closing inventory is 10,000. Am I right? Closing inventory 10,000 umbrellas. So they bought it for how much? Like when I see the purchase cost, it's $2. So $2. So that makes it 60,000. From 60,000 at the rate of $2, I'll remove 20,000. So like opening inventory plus purchases minus closing inventory. So $0 plus 60,000 minus 20. So we'll get 40. So $40,000 I'll remove from 100,000. I'll get $60,000. That is my gross profit. Okay. I know I have not written things very neatly. I have space constraint, but you can just check this here and you can update it. Okay. Fine. So I went to 100,000 and I removed 40,000. I got 60,000. Fine. Chalo. You see this? We'll go for the next one. Okay. Let's continue the example now. So we shall continue the example of umbrella shop into its next accounting year. That is October 1st, 2005 to September 30, 2006. Now, during the course of this year, Perry P. Louis purchased 40,000 umbrellas at the cost of $95,000. During the year, he sold 45,000 umbrellas for 230. So now you should be knowing one thing. Previous year, they bought how many umbrellas? 30,000. They sold how many umbrellas? 20,000. They are left with how many umbrellas? 10,000. That was the closing inventory for the previous year, correct? That becomes what for the current year or new year? Come on, tell me. Opening inventory. It becomes opening inventory for the current year. Okay. Last year's closing inventory is current year's opening inventory. So the value will be $20,000 of opening inventory. So let's now find out the revenue. So we will find out the revenue. No need to find out. They have already given the revenue. 45,000 umbrellas are sold for 230,000. So we'll take this. 45,000 umbrellas are sold for 230,000. Okay. Opening inventory 10,000 units, $20,000. They purchased 40,000 units in this year for $95,000. Okay. Excuse me. Excuse me. Yeah, so like 45,000 inventory was sold, and we definitely need cost for 45,000 inventory or units. See, if we are selling 45,000 units, we want cost also for 45,000 units to get the profit for 45,000 units. So opening inventory from previous year we were left over with 10,000 units. We did not sell it. So we took it as opening inventory this year. 40,000 units we purchased and the cost is 95,000. And this year also we did not sell 5,000 units. So what we are not selling, we'll remove from the units what we have, so that we can only take those units which we are selling and the cost of those units, okay, to match with the revenue of the units what we are selling. So 5,000 units costing 12,000 will be subtracted from 115. So cost of 45,000 units is 103,000, and the difference comes to 127,000, which is a gross profit for 45,000 units. Okay, so have a look through this. We'll move forward immediately. Yeah. So very nice and good scenarios are going on. So let's understand this. You should do this question. Come on, I'm waiting. Then we'll solve this collectively. I think I'm expecting you solving this, right? Hello?
Yes, sir.
Yeah, yeah. I don't think this much time you should consume for doing this simple question. What? It's so strange you're not doing this question very soon. So 2 minutes task. See how to do this.
Sir, it's 31,500.
How much? Hello?
36,500.
26,500.
Oh,
Okay.
sir, 36.
36. Okay. Hamsika, what's your answer?
Sir, I'm still doing it, sir.
Okay, do. Don't think such a challenging question. Doesn't seem to be. Okay, let's solve this question at last. I was expecting an answer, Amsika. Now, on 1st Jan, the Grand Union Food Stores had goods in inventory valued $6,000. So this is their opening inventory. And they purchased $50,000 worth of goods, and that amounted 80,000. So your sales is or revenue is 80,000. But see, but did they say that any of the goods is left over? No. So we have, do you think we have any closing inventory? No, we have nothing to, do we have? Oh, the cost of goods in inventory at 31st is 12,500. They have. So let's start this. The information is opening inventory. That is always reflected on the first day when you start the business. On Jan 1st, 2006, the opening inventory is $6,000. And the purchases during the year is like $50,000. Okay. And okay, they are selling it for $80,000. That's a different matter. Okay, the cost is $50,000. Cost is 50, selling price maybe something. They did not say any units here. They directly gave the amounts here, dollar amounts here. And what they are saying is the goods in the inventory is 12,500. So we will subtract that. So that is closing inventory. 12,500. When we see like 6,000 plus 50 minus 12,500, it is 43,500. And the goods which we bought for 50,000, we are selling for 80,000. So from that, when we remove this COGS, we get gross profit. Okay. Please have a look at this. We'll move.
Yes, sir.
Okay. Now the next section, cost of carriage inwards and outwards. We are going stage by stage. Now, till now, we did not consider any cost. Now we are going to consider the cost. Okay. Please focus here. Carriage inwards is included in the cost of purchases. Carriage outwards is a selling expense. The difference here is, see, this is Mr. A and he has purchased goods from a wholesaler, Mr. X. Mr. X is a wholesaler. So when Mr. A purchased goods from Mr. X, Mr. A purchased 100 units from Mr. X at the rate of $10. So it is $1,000 is the cost of material. Okay, $1,000. That is the inventory, number of units what Mr. A is purchasing from the wholesaler Mr. X. Okay, number of units which Mr. A is purchasing from Mr. X is 100 and Mr. X is quoting $10 to Mr. A for those 100 units and $1,000 is the purchase price. But do you think this is the entire cost of the inventory? No, there are some more costs to be added to this purchase price. Add carriage inwards. What do you mean by this carriage inwards? Carriage inwards is nothing but the freight charges incurred by the buyer. Okay, the freight charges incurred by the buyer. Okay, for what reason he will incur the freight charges? To bring this inventory, that is 100 units, from Mr. X godown to his godown. Am I right or wrong? Please tell me.
Right, sir.
Yes, and this he is going to spend only once. When he is going to bring this inventory from Mr. X premise to his godown or his premise. Okay, so what we have to do here is Mr. A is buying 100 units from Mr. X at the rate of $10. That is costing him $1,000. But if you think that this is the only cost which Mr. A will incur, no, stop there. The additional cost what Mr. A is going to incur is the transportation or freight charges or carriage inwards, whatever you want, you can say. And that should also be added to this inventory cost. Why? Because this is the cost which Mr. A is incurring and he will recover this the customers, or he will what he will do, he will set the selling price in such a way which would also be like such a price which would be sufficient for Mr. A to recover all his additional expenses apart from the purchase cost. Did you understand what I'm saying? Yes. For example, if I just take one box. Okay, let's say Mr. A is taking one box from Mr. X and that one box costs $10. Now Mr. A is paying $2 to the transporter to deliver this box to him. So $12 he is incurring. So he will sell this for $20. So additional, so he will sell this one box for $20. So now what is happening? Actually, the box price is how much? The box cost is how much to Mr. A? $10. Am I right? So easy recovering this $10 when he is selling the box for $20? Yes. And he's also incurring $2. He's also recovering extra $2 since he is selling the box for $20. Now my question is, if Mr. A would have sold the box for $10, then he would have made profit or loss? See, $10 is the box cost. $2 is the freight charges. The total cost is $12. Now Mr. A is selling the box for $10. Is he in profit or loss?
It's a loss, sir.
Why? Because he bought the box for $10 and he's selling for $10. So zero, no profit, no loss. It is break even. No, he has also incurred this freight charges. So that should also be recovered. So that's the reason why Mr. A will sell the box at such a price whereby he will be recovering these two costs. Okay. Understood my way of explaining this one? Yes. So now the second point, carriage outwards is a selling expense. Of course. Now this is Mr. A, Mr. X, the wholesaler. So Mr. A has bought one box from Mr. X. Okay. And this box is with Mr. A in his godown. Okay. This box needs some packaging, some labeling or something, and everything is done here. Now this box, so what cost Mr. A has incurred for bringing this box? The purchase price, okay, the purchase cost and the carriage inwards. So these two added together, can I say this is the purchase cost, total purchase cost? Please tell me.
Yes, sir.
Yeah, this is the total purchase cost. So total purchase cost. Now this particular like box has been packaged and everything is done. And it's a usual task for Mr. A to do packaging and branding and everything to the boxes and sell them to their customers in the market or deliver them to their customers in the market. And they do this on routine basis, on daily basis. Okay. So the carriage inwards is spent only when the inventory is bought at once. But the delivery is done to multiple customers on daily basis and spent on daily basis. Correct or wrong? It's a routine expense, and that particular like I would call that as carriage outwards. Why will I call this as carriage outwards? Now the box is processed by Mr. A and is being delivered to customers, and this is been done on daily basis, on routine basis. For that, whatever the expenditure Mr. A is incurring is called carriage outwards, and this is a kind of a selling expense. So this is a selling expense and should not be shown as inventory cost or should not be added to purchase cost, but it should be treated as selling expense and should be shown in the COGS, should be shown in the statement of profit or loss. Please tell me yes or no. Did you understand?
Yes, sir.
Yes. Who did you understand?
Yes, sir.
Yeah. So now need not worry. Our book is very like they elaborate on everything. It's very informative. So carriage refers to cost of transporting purchased goods. That is delivery cost from supplier to premise of the business which has bought them. Someone has to pay for these delivery costs. Sometimes the supplier pays and sometimes the purchaser pays. When the purchaser pays, the cost of purchaser is carried inwards into the business. When the supplier pays, the cost to supplier is known as carriage outwards, out of the business. So now what did you understand? To Mr. A, the cost is called carriage inwards. And to Mr. X, it will be called as what? Carriage outwards. This is a part of purchase cost to Mr. A. This is selling expense to Mr. X. Okay. Understood? Yes. Mr. X, Mr. A is the customer. Mr. X is the supplier. So now did you understand? I said everything very clearly. Now there is a task for you. This is the last task. And with this, we will wind up today's session. Tomorrow we'll start with this. I think tomorrow would be the end of the chapter. Tomorrow we can finish this chapter. I want you to do this question first. I'm waiting.
So what do we find out, sir?
You need to find out the statement of, you need to find out the profits, the profit from this business.
Okay, sir.
Okay, shall we do this now? Gwyn trading as clickety clocks, imports and resell clocks. He pays for the cost of delivering the clocks from his supplier in Switzerland to his shop in Wales. So that is, he is incurring some cost, and the cost is, I can say, carriage inverse. Okay, so whatever it is, every information is given here very clearly. On 1st July, he had clocks in inventory valued $17,000. So that is opening inventory, point number one. He purchased, so the purchases are given, the carriage inverse is given, sales is the total dollar amount given, other expenses amount this excluding cash outwards, which caused this. So these are other expenses which is a part of, which we cannot include in the inventory cost or cost of purchase, cost of goods sold. That has to be taken in the statement of profit or loss. And they have given the ending inventory as well, closing inventory. So we'll take the revenue. What is the revenue here? 1,61,200. So they have taken this. Opening inventory, they had 17,000. That's very clear. We take this. And purchases 75,000, and carriage inverse has to be added here. We know that. And the closing inventory has to be subtracted. We know that. The entire thing is COGS, and they get the gross profit. They have given the carriage outwards, which is not a part of other expenses, separated from that. That means these two are separate things. We have other expenses. Total 58,500. removed, we have the profit for the year, that is net profit. Okay, so this is the question what we have finished. Tomorrow we'll start from topic 1.7 dot 8, or even before. If I can try, I'll just come online and we'll start the class. Okay, we'll make sure to like finish this chapter by tomorrow itself. Fine, thank you. Hello.
Yes, sir.
Yeah,
Thank you,
okay.
sir.
Thank you so much. Yeah, see you tomorrow.